Hello and welcome to the latest edition of Damien's Midweek Markets, which is the show where I talk about what's been going on in markets this week and what to look out for in the coming days and week. Now, let's just take a check on where we were last week. If you remember, the S&P 500 was sitting at around 2873 and we had the oil price at 52. I did a whole show on why the oil price was important. And the US Treasury yield was at 2.12. Now, if we look at where we are this week, as I make this video, the S&P 500 has leapt above that crucial 2,900 level and sits at 2,917. Then the oil price is only marginally higher at 53. The US Treasury yield is even lower. It's now dropped down to 2.06. And the metric I've not spoken about for a little while, the VIX, the VIX, which is basically the market fear gauge, has actually dipped below 15. It's gone back above it. 15 is a key level. It's a level which generally below is positive for stocks and equities. Above is generally negative for stocks and equities. So it's good sort of benchmark. So if you look at all of those, if you take them in the round, what you've got equity markets higher with the S&P 500 as our indicator. Oil really the same, so the economic backdrop hasn't improved. We've got the Treasury yield falling, which means that the idea that people are still worried about the economics, perhaps a recession, is increasing, and yet the fear in equity markets has dropped. So why is that? Now, in summary, last week we had hope driving the equity markets that the Fed said they might be willing to cut rates. This week, what we had are two things. We had Donald Trump suggesting there's been an improvement or a likely trade truce at some point in the coming weeks, particularly centered around the G20 this week, which I'll come back onto. But more importantly, we had the ECB, the European Central Bank, surprising the market by saying that they are prepared to cut rates themselves. So that actually caused equity markets to rally. Now, this week was actually being billed as one that could make or break the market, and it was because we had the ECB this week making a policy decision. We got the Fed making a policy decision, and we got the G20 coming up. And at the G20, we were likely to see whether there would be any possibility of a trade truce between China and Donald Trump. Now, that first hint is that Donald Trump is suggesting that he might even meet his counterpart, President Xi of China, and we may have suggestions of even some sort of talk might occur. So we've gone from the trade truce and trade talks completely breaking down to Donald Trump suggesting that something may be starting to happen. Well, the market loved that. The European Central Bank, what we had there was something akin to what Mario Draghi did a number of years ago, where he tried to save the euro. He did the whatever it takes speech, that he said he would do whatever it takes to basically save the euro. And this speech he did this week had elements of that. So the market loved it. Don't forget, in simple terms, if central banks start cutting rates, possibly doing more quantitative easing, then it's seen as good for risk assets as stock markets tend to rally. But interestingly, the way they do that when they do QE is often to buy things like bonds. So bonds start to rally too. So that's why you've seen over the last sort of decade, you've seen equity markets rally and bond prices rise, which means their yields fall. So if you look around at the European space, there are negative yields on government debt everywhere, particularly in Germany. So the market danced to Draghi's tune. The thing was, he's actually front run the US Federal Reserve. Now, later today, we're going to have the US Federal Reserve do a similar announcement of their latest policy decision. There's been lots of pressure from Donald Trump himself. He's been tweeting endlessly, berating the US Federal Reserve and particularly Jerome Powell for not cutting rates. He's been berating Mario Draghi for suggesting that he was almost manipulating the currency. He's already been saying the same thing about China. So the pressure is on the Federal Reserve to deliver something today. People are hoping for an interest rate cut of some kind. If it isn't today, then they're hoping it will be perhaps in July. The problem is that if the US Federal Reserve, they're in a tight corner, because if they don't deliver something to the market, even if it's just more dovish rhetoric, then the market could have a wobble. The S&P 500 rallied so strongly after Mario Draghi's press conference that it busted through that 2,900 level. It leapt over 1% to take it to 2,917. So we are looking upwards, potentially, of trying to break towards those new all-time highs. It very much depends on what the Fed does and what happens with the trade war in the next couple of weeks. But that euphoria was felt globally. The FTSE 100 is back above 7,400. The DAX is at 12,300. We saw China rally over 1% after the news. We had the same thing in Hong Kong with their stock market rallying over 2%. So if last week's market was built on hope, this week's rally is built on not just hope that they might do it, but hope they're just about to launch QE or cut rates, and that's the central banks I'm talking about. But while we always focus on equity markets, if you've been investing in bonds, you've been being paid handsomely since equity markets fell in October. In fact, it's almost been a one-way street with bond prices rallying. We're talking about US Treasuries, we're talking about gilts. The gilt yield now on the 10-year is down to 0.8, which is crazy to think that just a few weeks ago it was up at about 1.2. That shows you how much money that has been made by those holding fixed income assets, and that's why they form a large part of my 50k portfolio and why it's made so much money since the sell-off in May. So the big thing to watch out for this week is what's going to happen with the Federal Reserve. That could shift markets massively one way or another to new all-time highs at 2,950 on the S&P 500, or they're a bit more hawkish than the markets would like them to be. Then we could see those lower support levels retested. Interestingly, if you look at the setup of the market, so again, I'm focused on the S&P 500 because it's leading the rest of the world. The rest of the world is lagging it slightly. But if you look at your stock app and you see those almost double tops that were forming. So we fell from October down into the lows of December on Christmas Eve, and then we rebounded to the recent highs in April. We started to roll over again, and we're suggesting there could be a double top, but now we're starting to rally again. It's interesting because you don't tend to see triple tops, certainly not quadruple tops. So are we just seeing the market that's going sideways? And if you look at your stock app, you can notice that the time lag between the different testings of those key levels of the new all-time highs are getting shorter and shorter. So we had an all-time high in September, then we had one in April. Are we going to get another one now in June? So the time lag is getting shorter and shorter. If that is true, then for the bullish people out there, that could be a sign that the market is trying to build that momentum to push through to new all-time highs. It's something we've got to watch. It's very dependent, as I say, on what the Fed does, on what central banks do, because they are driving markets at the moment, and what Trump does regarding trade wars. Because it's looking like he's going to extend his trade wars with pretty much anybody who's out there. One final thing before I wrap up, you'll notice that the pound has been struggling again. So we actually got down to about $1.25. So that is a recent low, and part of that is because people have been pricing the idea that Boris Johnson might be our next Prime Minister. If he is, then the suggestion is that he may actually back a no-deal Brexit, and so that would be very negative for our economy and therefore the pound. The other reason for the fall is you've got to think that currencies move in pairs. So we're looking at the dollar versus the pound. The dollar's been strengthening because the euro has been falling, and other central banks globally are starting to look at cutting rates or actually doing so. So the dollar's been strengthening. So that's part of the reason why the dollar-pound relationship has been weakening. So the pound has been weakening against the dollar. Because if you look at it against the euro, so the pound against the euro, there's not been the same movement. You can see that on your stock apps. So that is it for this week. If you've got any questions, then do email them in to Damien@moneytothemasses.com, and of course you can get me on Twitter @moneytothemasses with the number 2. Don't forget to tell everybody about the podcast, the Midweek Markets podcast, and of course our Sunday podcast. So until next week.